Hey everyone, ready to tackle the stock market in 2025?
Always exciting times.
Yeah, so we're going to dive deep, into this Motley Fool article.
Right.
It just came out like literally days ago, January 10th.
Yeah, I saw that one.
And it's well, the title's a little bit scary.
Oh, yeah.
This could be the biggest challenge the stock market will face in 2025. Here's what history says could happen.
Ooh, okay.
Dramatic.
Yeah, a little bit ominous, right?
Yeah, it definitely makes you want to click,
Exactly.
especially coming off of 2024.
Yeah,
which
I
was
mean, phenomenal year for the S&P 500, what, like 25% gains?
Yeah, around there.
So, like,
Pretty hard to beat.
really hard to beat, but that's what this article is talking about. Like, is that kind of success? Is it maybe a sign of trouble ahead?
Yeah, there's always that
Yeah.
little voice saying, what's the catch?
Exactly. So the article really focuses on this thing called the price to sales ratio.
Can you just, for maybe listeners who haven't encountered that before, break down what that is?
Sure. So price to sales, or PS ratio, is basically, it's a way to think about how much are investors willing to pay
Okay.
for every dollar of a company's sales. So
So is it like a
think about
valuation metric?
Yeah, it is a valuation metric, and you can think about it like this: like, if a company makes $1 million in sales a year,
Okay.
and its stock is valued at $3 million, then it would have a price to sales ratio of 3.
Got it.
Okay, so the higher the ratio, the more optimistic investors are
Yeah.
about the future growth potential.
Okay. I'm with you so far.
Yeah.
But like, why is that sending up red flags for 2025?
Well, because the current price to sales ratio for the S&P 500 is sitting at 2.84,
Wow.
which
That's high.
it is high. That's the highest it's been since 2021.
Yeah.
And it's quite a bit higher than the average of 1.79 that we've seen since 2005. So,
Okay.
it's elevated.
Definitely elevated.
But then you take it even further back to like the 20th century,
Okay.
for like 25 years. Plus, the average price to sales ratio was below 1.
Wow.
Wow.
So it's a huge jump.
It is.
Yeah.
It's huge.
So it seems like we're in the like really uncharted territory compared to, previous decades.
Yeah.
And,
Is it
I think that's right.
certain sectors that are driving this surge in valuations, or is it kind of across the board?
I think it's a little bit of both. You have
Yeah.
the overall market experiencing this surge, but then, you have sectors like technology, healthcare that are, known for
Growth.
their growth potential that tend to have higher PS ratios naturally.
Mm-hmm.
But even within those, you see companies where
Yeah.
it makes you scratch your head and say, is this really justified?
Right. Are these valuations justified?
Yeah.
So, okay, we've established valuations are high.
They are.
But, like, how do things actually shift?
Right. The article talks about, PS ratio contraction.
Mm.
What does that mean? Like, how does that happen?
Yeah, so there are two main ways that ratio can shrink.
Okay.
One is that stock prices fall,
Okay.
and the other is that company revenues rise.
Okay.
And typically, historically, it's been falling stock prices
Interesting.
that have been the main driver.
Now, why is that? Why wouldn't the rising revenues kind of balance things out?
It's a little bit more complex, you see, when a company's revenue increases.
Yeah.
That can actually fuel investor optimism,
Right.
which can then lead to further stock price increases.
Oh, so it's almost like
So it's cyclical.
it feeds itself.
Yeah.
Yeah. Okay.
Kind of think of it. It's
Interesting.
like the 2007-2009 recession.
Okay. Yeah.
Stock prices plummeted over 50%.
Right.
And that pulled that PS ratio down, even though some companies were still reporting pretty decent revenue growth.
So it's almost like it's detached from the
It can
underlying performance of the companies.
be. It's more about
It's
sentiment.
like market sentiment
Yeah,
takes over.
exactly.
Okay, so this potential for a correction in 2025, is that mainly tied to this high PS ratio, or are there other like economic factors that are kind of
I think
Get
that's
to there.
later. PS is definitely a warning sign, but there are other concerns brewing out there.
like what?
Well, for one, you've got the incoming Trump administration
Yeah.
and their proposed tariff increases.
Right.
So how those play out could really impact
That's a big
economic growth.
wild card.
Yeah.
Yeah.
And corporate earnings.
And then I'm also thinking about inflation. The article mentions that it's still above the Fed's target and could lead to interest rate hikes.
Yeah.
What are the potential consequences of that?
That's a great question. And inflation, is the rate at which prices for goods and services increase.
Right, right.
So, when inflation gets too high, it erodes the purchasing power
Right.
of your money. So the Federal Reserve, they want to keep inflation around like 2%. So if it stays above that for too long,
Yeah.
they might raise interest rates to kind of try and cool things down.
Okay, so that makes sense. They want to keep inflation in check. But how do interest rate hikes actually like combat inflation?
Well, when interest rates go up, borrowing money becomes more expensive
Okay.
for both individuals and businesses. So, think about loans
Right.
for houses, for cars.
Mm-hmm.
They become less appealing. So this kind of slowdown in borrowing and spending can help
Okay.
curb inflation.
So I'm with you so far, but then how does that connect back to the stock market?
Well, when interest rates rise, bonds start looking more attractive
Okay.
to investors because they offer a higher guaranteed return.
Right.
So this could lead to investors kind of shifting their money out of stocks and into bonds, which could trigger...
A market correction.
Exactly.
It seems like everything is pointing in that direction.
It's a possibility.
It can feel a little bit overwhelming,
Yeah.
to hear all these potential risks.
Yeah.
But you mentioned earlier that a correction isn't necessarily a bad thing.
Right.
Can you elaborate on that? Like, what are some of the upsides?
Yeah, absolutely. So market corrections, while they might sound scary, they can actually create some buying opportunities.
Okay.
If stock prices fall, that allows investors to buy shares of strong companies at a discount.
So it's like a sale.
Exactly. It's like a sale on Wall Street.
Okay, so it's not all doom and gloom.
Not at all.
For someone just starting out or, even seasoned investors looking to add to their portfolio,
Yep.
a correction could be a chance to kind of snag some deals.
That's right. But there's a catch.
What's that?
You need available cash to seize those opportunities.
Right.
You don't want to be in a position where you have to sell investments at a loss
Right.
just to free up funds.
So having a cash reserve, it seems like, is super important
It
for
really helps you.
navigating these market shifts.
Stay agile.
Besides having cash on hand, are there other strategies that investors can employ to kind of weather a potential correction?
Yeah, diversification's always key. Don't put all your eggs in one basket.
Right. Spread the risk.
Exactly. Spread your investments across different companies, sectors, and asset classes.
So the classic advice holds true, it seems like.
Yeah.
It's easy to get caught up in, the hype of a specific company or industry,
Right.
but spreading that risk is just essential for that long-term stability.
Yeah, it's about managing risk effectively. And, it's important to remember that market corrections are a normal part of the economic cycle.
Right.
They happen periodically, and historically, the market tends to trend upwards over the long term.
So if you have a long-term investment horizon,
Yeah.
A correction, it might feel like a bump in the road.
Right.
It's not a reason to panic and sell everything.
Exactly. Keep a cool head stick to your investment strategy and remember your long-term goals.
All of this talk about valuations and potential corrections kind of has me thinking back to something the article mentioned, which is that there are like structural reasons why investors might be willing to pay more for stocks now compared to, say, like 40 years ago.
Right.
You remember that?
Yeah, they talked about like the rise of IRA.
IRAs, yeah.
Individual retirement accounts.
Yeah. Can you explain how IRAs have kind of shifted things? Like, why would they make investors more comfortable paying these higher prices for stocks?
Sure. So, before IRAs were as common as they are today, most people relied on traditional pension plans for retirement.
Yeah.
And those were managed by professionals who typically invested in a mix of stocks and bonds. But with IRAs, individuals are responsible for managing their own.
It's like a hands-off approach to more DIY
Exactly.
style of investing for retirement.
That's right. And since stocks have historically outperformed bonds over the long run,
Right.
many IRA investors allocate a larger portion of their portfolio to stocks,
Okay.
even if it means, accepting those higher valuations.
So the popularity of IRAs could be contributing to these elevated PS ratios
That's one possible explanation.
that we've been discussing.
Of course, it's not the only factor.
Right.
There are other structural changes in the economy, like the growth of the tech sector and globalization that have also influenced, market dynamics.
So it's like a really complex web of interconnected factors
It is.
that are shaping investor behavior and market trends.
It's fascinating.
Yeah.
Really is.
Yeah. Yeah. It really highlights how much has changed, even in just a couple of decades.
Yeah, for sure.
So taking all of this into account, these high valuations, the economic uncertainties, these structural shifts, what's kind of the key takeaway for the everyday investor trying to, make sense of the market in 2025?
I think the most important thing is to not get caught up in the hype and make decisions based on fear or speculation.
Right.
Stay focused on those long-term goals. Keep your portfolio diversified. And remember that market corrections are normal.
It's easy to get caught up in the day-to-day, fluctuations.
Absolutely.
Having that long-term perspective is so important.
Absolutely.
And of course, like we talked about, having a little cash on hand can allow you to take advantage of those opportunities.
Take advantage of those sales when they pop up.
Exactly. Well, this deep dive has been super insightful. I feel like we've covered a lot of ground from, that price to sales ratio to the impact of IRAs.
A lot going on out there.
Yeah, a lot going on. But I always like to leave our listeners with something to think about.
Okay.
So, the article pointed to structural reasons for these higher valuations today, but what other factors might be at play? Like what trends, maybe some that we haven't even considered yet, could be shaping investor behavior and driving these valuations in the years ahead?
It's a great question, and I'm sure, analysts and economists are going to keep digging into that.
Keep researching that.
Yeah, the market's always changing. So
that's what makes it exciting, right?
Exactly. It's always something new to learn.
It's always something new to learn.
Yeah.
Well, hey, thanks for joining us for this deep dive into, the potential challenges and opportunities in the 2025 stock market. And until next time, everyone,
keep learning.
Keep learning.
Keep asking questions.
Keep asking questions.
And keep investing in your knowledge.
I like that. Thanks for joining us.